First one, we have return on capital employed. So that's our first one. So we have return on capital employed. So this is abbreviated as ROCE. So we have return on capital employed, and we find the return on capital employed. So we are going to say return on capital employed is equal to profit before interest and tax divided by capital employed. So this is the formula that we use when finding the return on capital employed. We say profit before interest and tax divided by capital employed. And we know that we can find our capital employed there. So we can say capital employed is equal to fixed assets plus working capital. So that's the formula of finding capital employed, and we know that we can find our working capital. We can find our working capital there. So working capital is equal to current assets minus the current liabilities. So that's the formula that we use when calculating working capital. So let us look at the formula. So we have said the formula of calculating return on capital employed, it's profit before interest and tax divided by capital employed. And we can calculate our capital employed by adding the fixed assets and the working capital. And we can find the working capital by subtracting the current liabilities from the current assets. So the return on capital employed, this is the amount of profit as a percentage of capital employed. Adequate return on capital employed is the reason why the person invested their money in the first place. If a company makes a profit, we do not know how good or bad this profit is until we look at the amount of capital which has been invested to achieve the profit. In other words, this ratio relates the net profit to the level of investment used to earn it. So this type of ratio actually compares the amount of money that you actually invested with the profit that you got. So let us look at an example. So there is an example here, and for this example we have the balance sheet and the profit and loss as you can see. And from this information we can calculate the return on capital employed for 2 years. We have 2017 and 2018. So we know that when calculating return on capital employed, we say profit before interest and tax. So what is our profit before interest and tax for 2017? So for 2017, it's let me just put this. We have 1071. This is the net profit before interest and tax. So we are going to get this for 2017, and for 2018 we are going to get 1445. So we can calculate for 2017. So we can say this is 2017. So return on capital employed is equal to profit before interest and tax divided by capital employed. And we have said for 2017 it's 1071. So 1071. What about the capital employed? So capital employed, we have said this is equal to the fixed assets plus the working capital. So from this we know that our current assets, we have this. So we are going to say this, we're going to say 5100 minus our current liabilities, which is 1578. And after getting your answer, that will be your working capital. After getting your answer, you add it to your fixed assets, which is 6192. And you're going to discover that you're going to have 9714. So we're going to multiply it by 100, and your answer there is going to be 11.0%. Let us calculate for 2018. So return on capital employed. So profit before interest and tax divided by capital employed. So profit before interest and tax for 2018, we said that this is 1445. 1445 divided by capital employed. Just do the same thing. So the first thing that you say your current assets, which is 4036 minus 1959. Your answer is going to be your working capital, and after you do that, you add 7775, and your answer is going to be 9852 multiplied by 100, and the answer there is going to be 14.7%. And as you can see here, we can compare the return on capital employed for 2 years. So here there was a high return on capital for 2018 than 2017. So it means the year of 2018 the business was doing better in terms of profit than 2017. Let us look at return on equity.